What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is March 28th of 2020. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I want to go about trying to answer a very important question, and it's one that's on the minds of many people, and that is whether or not we've found a bottom in equity markets, as we've had one of the most stark sell-offs for this kind of time window, a faster sell-off than 1929. The question here is whether or not that sell-off is going to continue, as the Fed has started to make pretty stark responses, responding with over $4 trillion of quantitative easing or new cash into the banking sector, as well as the federal government doing a $2 trillion bailout, the largest we've ever seen in history. So these are very important questions. And then outside of that as well, whether we are at a bottom or if we still have a ways to go, what are the sectors we're going to be watching for where we can find some sense of value? Maybe companies or industries that are undervalued, or ones that in this case maybe have just been dramatically sold off. Okay? So we've got lots of things to discuss right after our quick sponsor. Our sponsor for today's episode is Ledn.io. For those of you out there holding Bitcoin long-term like myself, why not put it to work? Ledn has a suite of services to help you save, earn, and hodl more Bitcoin. Their B2X loan service lets you double the amount of Bitcoin you own through a Bitcoin-backed loan. Their savings account lets you earn interest on your Bitcoin, paid out in Bitcoin, so you can grow your holdings over time. And with their Bitcoin-backed loans, they let you access cash in a tax-efficient manner while keeping your Bitcoin under insured custody with BitGo and real-time proof of reserves. Get a 250,000 Satoshi bonus if you register with the link below and get a loan today. Alrighty, so let's go ahead and start off with this very important question, and that is whether or not we've actually bottomed in equities in this sense. Has the stock market seen a bottom? Is the sell-off over? And as some of the headlines have already been reading that the bear market is over, have we finally seen the worst of it in this case, right? And I think this is a very important question, but I can answer it in a very simple way, guys. So there's two things I would say to keep in mind here, and I'll go ahead and just give you the answer straight out. I don't believe we've seen the worst of it, and I'm not just trying to be a pessimist. I'm not trying to be biased in my own thoughts. I really looked for two things here to really determine whether or not, in this case, we've seen the worst of it. The first one here is understanding how COVID-19, which has really sparked this sell-off, how it actually is going to work over the next few months. Now, I can't tell you what the case numbers are going to be a month from now. I can't tell you how many companies are going to be affected by this specifically. There's no way we can get that kind of data. What we can understand is a valuable understanding of how COVID-19 is going to be treated both in the United States and across the world. We've seen that quarantining is an effective measure fighting against COVID-19, but it's not a cure-all be-all to end the spread of COVID-19. What it is it's a mechanism to buy us time, because COVID-19 itself is going to linger on until we get a vaccine or until we build up some sense of herd immunity. It's kind of the end reality of all of this. But the key thing to take into mind here is that when we do these quarantining periods like we've been in right now, many of you have probably been staying home during this time period, the major thing that we're doing is we're making sure to keep the case numbers low enough so our healthcare system can respond to it in this case. So we're going to be going through these kind of seasonal cycles for COVID-19 until we actually come through and start to see a dramatic reduction in numbers. And that's going to come to the two things we mentioned, either a vaccine of some sort or, again, general herd immunity to the virus. And this takes time. It's going to be over a year. And because of this is going to leave a lot of businesses when, for example, we end the quarantine in probably a couple of weeks to a month. They're not going to reopen. They're not going to rehire at the rate that people are probably expecting now that we just threw a huge stimulus package at the market. Plain and simple, guys. It leaves a long-term lingering effect. And you also have to think about the consumer as well, right? The consumer is not going to go out and buy a lot of the things they were buying last week when the economy was roaring, when they were doing well. Now they're in an environment where they're living paycheck to paycheck in this case, and hoping, if they're lucky enough, that they're going to get their job back in some cases, right? This is the cold, harsh reality of where we are right now. This is basically what's setting us up likely for a depression. But there's a second component as well. History tells us that in this case, we tend to find most pullbacks put us in a position where the correction is much shorter than the overall expansion to get back to where we were, okay? So let's go ahead here. We're going to take a look at a really interesting chart. The speed of recovery versus the speed of decline. And I'll go ahead and I'll zoom out a little bit because I want to make sure my webcam isn't getting in the way. But we can see here that we have 10 awesome charts here that showcase some of the larger corrections throughout history, some of the more significant time periods. You've got, for example, 2008, you've got the popping of the dot-com bubble, and you have 1987 as well as 1932. Again, very similar time periods and stuff in the sense of significance of what we're talking about, and time periods that you might know about if you studied financial markets, right? Now, the one thing I want to explain in the sense of this chart, because it might be a bit confusing, is it's measuring two things on the Y and the X axis: the percentage versus the prior high in this case. And along with that as well, it's showcasing us the time period here for where we had our peak, from where we had our trough, basically back to the highs, and then our bottom. Okay, so this is very, very important to understand here, folks, to just understand what we're looking at in this case. And what you'll see, generally speaking, I can go ahead and summarize it for you. You could take your time looking at this, or you can see here, for example, in 1932, it took 33.3 months to go from the top to the bottom, and over 271.6 months to get back to that high. So almost 10 times longer in this case. Not exactly, but pushing again towards a very long period of time, multiple years, right? So if we understand this in this case, how the chart works, we can generally summarize here that over 8 out of 10 of these cycles, these bear markets, had longer periods of time of getting back up to their all-time high versus going, in this case, faster back to the highs. Now, why am I talking about this? Because it is true. We could have hit a bottom right now, guys. No doubt about it. It might be that we're at the bottom and that we might just linger onto the side here. But what a lot of people are hoping for with the Fed's immediate response and the government's fiscal policy is that we're going to get a V-shaped rebound. Now, that's not what they're talking about here. The V-shaped rebound would be that in the next couple of months, like 2 or 3 months, we're going to have a sharp rebound back up to where we were. And quite frankly, we don't see that much in history. We barely see that. We have that in a few occurrences here, like 1970, but bear in mind it was over a multi-month period for both the downside price action and the upside price action. And here in 1962, right? But outside of this, right, we're talking about much longer periods of time before we really get rebounds back up to these values. In many cases, multiple years. So I don't think we're going to get that. And I don't think we're going to get it in an environment where businesses are going to be uncertain about hiring people yet again over the next 12 months if we're going to be doing these quarantining cycles where eventually we're going to have to lock down again, then let the case numbers go down and reopen, right? That's generally what's going to be happening here. Now, what's good, positive news for people who want to take a more optimistic tone, is that we'll probably be able to have a higher amount of case numbers as the healthcare system will be able to supplement more. In this case, we'll be better prepared with ventilators and masks and treatment options. So now that we've talked about this, right, we understand that it's a likelihood that the recovery is going to take a very long period of time. And it's likely that if this is a full-scale recession and likely a depression, then we have to have a target range for where we think equities are going to go, or where do I generally think we're going. Well, again, that's just my opinion, guys. You should not use my opinion solely in order to make a decision, but I will go ahead and share with you where I do believe we're going. It's a very rational level, right? Especially for a depression of some sort, where I do believe we're going to be coming somewhere between the resistance, the highs of both 2007 and the dot-com bubble in 2000. And also, it's going to be slightly below the support range back here in 2014 and 2015. And that would lead us right here on the S&P 500 around 1,700 points. Exactly half of where we were at the peak of the S&P 500, which was 3,400. And again, as I've already mentioned that, you can go ahead and you can just draw it here on the map if you don't believe me on the math here. You can see here that leads you to exactly 50%, right? Again, we'll probably go change that to red. Now, I don't know the time range this is going to take. All I'm looking for here is the price, right? And I want to be very clear here, guys. I'm not going to wait exactly for 50% pullback, 50% pullback for me to start building a position. That's just being too stingy in this case, right? We do not want to wait for an exact immediate pullback. In fact, the smart investor is usually a little less greedy. They'll usually pay a little bit more of a premium because generally speaking, if let's say, for example, you were to buy in at this range around 2014, 2015 price levels at 1800 and 1900, it's not exactly our target, but we know that our risk to reward is likely favorable in that level, right? I'm not saying there's a guarantee of that, but for my model in this case, if I'm expecting it down here, right, I've already seen the vast majority of the correction. It's probably better for me in this case to take on my position versus waiting it out and being stingy and saying, no, I'm going to wait for another 100 points, and then it never happens, right? Let's say there's other buyers who come in early and then the price never goes down to that range. So it's something where you can start to average in if you really want to. But now that we understand that target range, right, it's somewhere down here between 1,600 points to 1,800 points. That's the general range I would look for. Now that we understand we've got a far ways to go. So the key here is patience. First thing we have to understand is we have to remain patient. Again, you might have a different target range. In my case, I'm going to have to sit tight for a little while. And the second thing that I want to talk about is the industries that I think are going to make a pretty resilient comeback. Now, I am interested in a lot of different things because I'm interested in the tech sector. I really got my kicks, investing in a lot of emerging sectors such as semiconductors, companies like NVIDIA Corporation that makes graphics cards, as well as a lot of other big companies in that industry. There's also the solar industry, which is one we're going to be talking about that I really like. But I want to go ahead and be very clear here and talk about my 3 sectors that I'm going to be watching for. Many of these are not sectors that I per se want to hold for a long time, and along with that as well are very speculative or short-term cycled industries that I know are going to make a pretty sharp rebound or are in a very dark position right now where there's not much room to get worse, right? So I want to go ahead and talk about this. And again, these are not really per se my long-term industries. These are simply industries that I think provide a good profit potential in the sense of their equities, in the sense of their spot price, or maybe their dividends, okay? So let's go ahead and dive into it. The first one is a extremely hard-hit industry, and that is the energy sector. The energy sector has been one that I've traded before, I've watched for a long time, and has gone through one of the most stark corrections out of any other industry, not just in 2020, but also really over the last decade. So let's go ahead here. We'll take a look at XLE, which is one of the broader ETFs here for the energy sector, and you can see here just the sheer amount of decline we've had. And we're taking a look at the monthly chart here. So each of these candles is a month's worth of price action. You can follow the timeline here from each year, from 2008 here to 2020. We are now below, as an industry, below values from 2008. After the commodity boom bubbled, the commodity bubble the commodity bubble had bursted in this case back in 2007, right? We can see here that we're now down at $28 versus a valuation of $40 for the ETF. And from a peak here in 2014 of $101 down to $28. And this isn't even the worst. We were tailoring down at $22 to $23 just a couple of days ago. So what's the key thing to take away from this? Well, what's going on in the energy sector? Well, the major thing that's going on in this sense of oil production and natural gas is a price war, specifically in crude oil. Russia and Saudi Arabia right now are going through a massive price war in this case, where they're basically trying to stake out how long one another can keep overproducing. Oil, just like any other commodity, is a game of supply and demand. People who want to produce, because that's how they make their money, that's their businesses, they're going to try to produce as long as they can until they burn out of cash and they have to close down operations. And this is what leads to oversupply. And the worst thing about this as well, guys, is this is coming in the midst of where general oil demand is already falling. And we also just had one of the biggest declines here for oil due to COVID-19. If you're not driving to work, if your company is shutting down operations in the meantime, right? Not all companies, but a good amount. That's going to lead to a stark decline in oil, the most unprecedented decline in oil that we've seen in history. So this is why oil has sustained its price around $20, because all of the producers, even U.S. producers, are still producing right now, and many of them are bleeding cash at the moment. So what this is going to lead to is inevitable bankruptcies. The energy sector is overly bloated with basically really terrible corporate debt in this case. That's most likely to be defaulted on. But all in all here, this means that this sector here is going to have to cycle out some players. There are going to have to be some major bankruptcies, some major cutbacks in production, and inevitably, after all the blood has been spilled here in the industry, it's going to be a matter of finding out which plays offer value here, who will be able to weather the storm. And as prices start to come back up to more reasonable levels, such as $35, $40, maybe even $50, in this case, some of these producers will stop bleeding as much as they are, or they might be able to turn a profit. That's what we look for here, right? So again, anything below 40 is going to be difficult for most U.S. producers, but no doubt, even if they're not producing money, if they're not bleeding as much and they can sustain a much longer period of time, then in this case, we want to look for some companies that will provide value. Now, there's a lot of different oil producers, but I want to go ahead and make it very clear, guys. I'm not an expert in understanding the balance sheets of these companies, knowing which ones can and can't weather the storm. The general play here is that you want to wait a good while as this lingers on down here. You want to wait a while and see how long certain companies are lasting as the oil price is continuing to press sideways $20. The opportunities of which companies will succeed will start to filter out quite nicely because you're going to start to see a lot of these companies delist. They're going to go off exchanges. And then outside of this as well, guys, we've talked about oil, and also, again, you have to keep an eye on natural gas. I think I've got it here. If we can actually just type it in here, nat gas. Right? Nat gas, again, getting towards its lower range here. We've had this drawn on my chart. We've talked about it in the newsletter consecutively, time and time again, how natural gas is coming down here to about $1.10 per CFD. It's been continuously setting new lows, right? So this is a weekly chart here. We've gone all the way from $4.82 equivalent for this amount of natural gas down to $1, or well, $1.61. And it looks like we're going even lower. So as we go for these next 6 to 12 months, this is the time period to sit back patiently, at least in my opinion, and see which players are valuable here, which ones are going to weather the storm and still produce for global supply after the storm's over. Because the world does need oil and natural gas right now, at least in the current environment we have. People are driving cars, we're importing and exporting things. Oil and natural gas are needed, right? So it's a matter of finding what players are going to weather that storm that may be available to trade for us, right? Outside of that as well, I would say the other thing to look at is the solar sector. Now, this is again playing into the energy category here. I'm again a big believer that renewables and also things like nuclear energy are going to take up a larger chunk of the energy portfolio over the next coming years. But we can see here right now that the solar sector has almost gone through a 50% haircut, going up here to $41 and around 80 cents here for the peak, and coming down here to $21 at the bottom. I believe we're going to roll back over here, and we'll get a chance to possibly get in here around 20. But again, I'm not going to get greedy if things start to reverse here soon, right? If we do get that V-shaped rebound. But again, I would do a split in this case for me personally for a 33% allocation of my maybe more short-term holdings between TAN, which in this case is a solar ETF, or maybe individual solar players such as CSIQ or Run, for example, Sunrun, which is a residential solar installation company, and then also half into a lot of oil producers, some of which, again, I would do a diverse broad exposure into a lot of the smaller mid-cap plays where one or two could really come out strong, whereas a lot of them will probably struggle to make a solid rebound. Okay, so that's what I would look for there. Now, that's 1/3 of what I'm watching. The other third here is the cannabis industry. I've been waiting patiently. You guys know I've been talking about cannabis. I've been studying this industry since 2011, but I have waited patiently to finally get a stake here in cannabis markets. And we can see here that the Canadian index here, which peaked out back in January 9th of 2018, came in at a value of 1,045 and is now trading at a value range of around 117, 130 here. Right? We had an absolute bottom here of about 87. We have had more than a full 90% correction across the board. This is bottom territory. This is what I like to look for. Now, I'm not saying the cannabis industry is going to be easy to spot key players here that are going to win out in the long term. Again, as I emphasized earlier, I don't really care to hold the energy sector long term. The energy sector is very cyclical. Same here with cannabis. It's a speculative market. It's very difficult for one player to come in and monopolize it or to really own the market in some degree. Again, we're in a very speculative phase here, but I can tell you here, much like how the broader cannabis sector moved up here all the way from 232 here in just basically the summer 2017 into the beginning of 2018, right? Just a few months here. I know, generally speaking, that the broader cannabis sector is going to be revived as well, most likely, if we start to see some of the key players lead. So, again, I've got a cannabis portfolio here. It's not really a portfolio myself. These are companies that I'm watching. And you can see here the other day, guys, we had a pretty big rebound. You can take a look at MJ, one of the biggest rebounds here on the weekly. Or for multiple days, we got a big rally here. We get some big volume on some of the players, like Tilray, for example, going from $2.45 to $9.10. Hexo, for example, going from 33 cents to $1.09. You also have Kronos Group coming from $4 to $6.29. So you have a lot of different plays. Canopy Growth Corp from $9 to $14.59. Some pretty big rebounds here, right? But again, I'm not buying in yet. I'm waiting until we linger around this price area for a while and solidify that we have made this new support. Okay, so it's one of the sectors that I'm watching here. I like simply for the fact that it's a new emerging sector, and along with that, it's at a 90% decline, if not more, in the sense of some individual stocks. So that's the second sector I'd watch for more of a kind of longer term trade, as I would with energy. And the third here is remote work. So there's not much articles needed for this, guys. Again, we could take a look at some broader indexes. We could talk again about the macro perspective. Macro perspective is very simple. We're in a rough time here in the sense of the economy, right? And this is why I want to emphasize people learn about investing, learn about financial opportunities where you can hedge a rougher economy where the jobs market's just going to get more and more difficult. But there's a few companies that are really going to be boosting throughout the gig economy. And during this environment, the gig economy is going to be roaring. We talked about this in the newsletter as far back as if I recall correctly, I think it's January. We started to having our top 3 picks, at least for me personally, for equities. One of these was Upwork. That's what we're looking at right now. Upwork had its IPO back in October of 2018, and ever since it has been pulling back here towards a much more reasonable value of about $740 million. But the company itself is one of the leaders in the sense of online remote work, online freelance work in this case. So again, I would recommend keeping an eye on Upwork. I'd recommend keeping an eye on Fiverr as well, right? Fiverr as well, Fiverr International. It's a website where you can get people to do, again, gig work for just basically one fixed rate. So these are the kind of companies I'd look for. And again, possibly look at some of the larger plays like Uber. I just think, guys, I hate to buy into a company like this because Uber's already well overvalued. It's already at a valuation range where you're not going to see a doubling in value, and at least in my opinion, anytime soon. Same goes with Lyft and a lot of the other well-known large kind of industry gig players, for taxi driving and things like that. I think you're going to see a lot more digital work come into the gig economy, right? So anyways, these are 3 industries that I'm looking at here. I know they seem kind of niche, they seem off-putting, but sometimes that's where the value is, guys, right? I remember years ago when I was making investments in the solar sector and semiconductors. Some people were like, well, why? Well, semiconductors, that sounds boring and dull. Like, well, semiconductors had a massive rally. They were one of the best performing sectors back during like basically between the time period of 2010 and 2020. Like back in the middle part of that decade, semiconductors were killing it. And there's also a lot of other sectors that, again, just might not seem interesting to some people, but it's where you can find a lot of value, right? Now, we've also talked as well in the energy sector. I want to make it clear that I'm looking at a lot of uranium players as well. That's another thing. Again, we're in a commodity cycle here where commodities are extremely cheap. So we're probably going to be experiencing some form of a bottom here over the next couple of months to a year or two. So anyways, that's it in the sense of the bulk of the content here, guys. And I want to make it clear as well that I'm still mainly exposed to cryptocurrencies, right? I'm still mainly holding Bitcoin at the moment. I'm still mainly holding altcoins, right? Cryptocurrencies are where I'm at the moment. But if you do want to get some exposure to cryptocurrencies or equities, again, there's a lot of different platforms. For the sense of equities, I use Robinhood in this case. It's just very simple. It's zero commission, and I can just average in over time and do a lot of different positions. But for those of you who want to use cryptocurrencies as a part of your portfolio, you can always check out eToro, our sponsor. Now, eToro is a really great platform. They not only allow you to communicate with other traders, as well as utilize their copy trader feature, where you could copy alongside me at the exact same price and at the exact same time. But you could also just buy some individual cryptocurrencies yourself, especially as we've seen seen most assets such as stocks and crypto decline. So if in this case you want to buy some, definitely check out eToro down below in the link in the description, and you can support the channel by doing so. That being said though, guys, thank you all so much for watching. I hope you all enjoyed this topic of kind of analyzing the broader equity market, and along with that as well, diving into some individual sectors that I might be bullish on. But I want to know from you, what sectors are you optimistic on? Because for me, guys, I'm always interested to hear about new companies. I can't tell you how many times I've been thankful that a friend has just kind of showed me certain industries that I had no idea about, and I look into them, and I'm definitely eager to research them more, and sometimes I've made investments and they've done well. So again, I want to hear from you guys. What do you all think is the best company or industry to focus on right now? All right. Again, want to hear from you guys. Get a discussion going down below in the comments. And I hope above all that you're having a wonderful day wherever you are. And I'll see you all in the next video. Stay tuned.